On January 29th, 2025, something impossible happened. Gold crashed in New York, but in London, the price held steady. In Mumbai, traders saw completely different numbers. The same metal, the same moment, 3 different prices. In a world connected by computers that trade in microseconds, this cannot happen by accident, unless someone wanted it to happen. What you're about to discover isn't just market manipulation. It's evidence of something far larger. A coordinated strike that reveals the true battle being fought behind closed doors. And if you're in business, if you handle international contracts, if you manage corporate treasury, what happened on this single morning changes everything you thought you knew about how markets actually work. Welcome to Global Finance Revealed, where we decode the financial events that shape your business reality. If you've been watching our channel for years, you know we don't waste your time with speculation. We deal in documented evidence and strategic analysis. Would you do us the courtesy of clicking that subscribe button? Think of it as joining a private briefing room, the kind where serious people discuss serious money. We'd be honored to have you as a regular attendee. And please drop a comment below telling us where you're watching from today. Are you in Singapore, London, Dubai, New York, Lagos? We're building a global network of informed professionals, and your perspective matters. Now, let's examine what really happened on that extraordinary morning. The financial markets opened on January 29th, 2025, like any other trading day. Algorithms hummed, traders settled into their routines, coffee machines gurgled in dealing rooms from Tokyo to Frankfurt. Nothing in the pre-market data suggested what was about to unfold. Then, at precisely 8:30 a.m. Eastern Time, the impossible occurred. Within 17 minutes, the price of gold on the New York COMEX exchange plummeted by $487 per ounce. Silver collapsed by $14.70. The charts showed near vertical lines downward, the kind of price movement typically reserved for corporate bankruptcy announcements or geopolitical catastrophes. But there was no catastrophe, no unexpected economic data, no central bank announcement, no war declaration, just a crash. Financial journalists scrambled to explain it. The usual phrases appeared within minutes. Profit-taking, technical correction, overbought conditions being resolved. These explanations satisfied the casual observers. They always do. But someone checking prices across multiple markets that morning would have noticed something that transformed this event from unusual to unprecedented. To understand why this matters, one must understand a fundamental principle of modern markets: arbitrage. Arbitrage is the practice of buying an asset in one market and simultaneously selling it in another to capture a price difference. In today's high-frequency trading environment, sophisticated algorithms scan global markets millions of times per second, searching for price discrepancies of even a few cents. When they find a gap, they exploit it instantly. The very act of exploiting it, buying the cheaper asset, selling the more expensive one, causes the prices to converge. This process typically takes milliseconds. A $336 gap should trigger an arbitrage feeding frenzy. Computers should buy cheap New York gold and sell expensive London gold faster than a human can blink. The gap should vanish almost as quickly as it appears. But it didn't. The divergence persisted for hours. Not seconds, not minutes, hours. This is the equivalent of finding water flowing uphill. It violates the basic physics of how modern markets function. Several explanations exist for why arbitrage might temporarily fail. Perhaps the New York market experienced a technical glitch. Perhaps trading was halted. Perhaps liquidity evaporated so completely that no one could execute the arbitrage trades. But examination of the trading data reveals none of these conditions existed. COMEX operated normally. Volume was extraordinarily high, not low. Circuit breakers were not triggered. The exchange functioned exactly as designed. The infrastructure worked perfectly. The price discovery mechanism did not. For business leaders operating in international markets, this divergence represents more than a curious anomaly. It signals a fundamental breakdown in the assumption of unified global pricing. Consider a mining company with operations in 3 countries, each using different pricing benchmarks. Consider an electronics manufacturer, hedging precious metal inputs for production 6 months forward. Consider a central bank managing its reserves across multiple jurisdictions. When the same commodity trades at radically different prices simultaneously across integrated markets, every contract becomes ambiguous. Every hedge becomes uncertain. Every financial model becomes unreliable. The standard explanation, that this was simply an unusual trading event, fails basic scrutiny. Markets connected by fiber optic cables and staffed by algorithms programmed to exploit the tiniest inefficiencies do not sustain 336 price gaps for hours by accident. Which leaves only one logical conclusion. This was not an accident. The divergence was either caused by deliberate intervention, or it revealed that the global pricing system had fractured in ways not yet publicly acknowledged. Either explanation demands serious attention. What happened next would provide crucial evidence about which explanation was correct. The answer lay not in what happened, but in how it happened. Market manipulation is rarely obvious. Professional manipulation doesn't announce itself with crude methods or visible fingerprints. It operates within the technical architecture of markets themselves, exploiting the very mechanisms designed to ensure fairness. To understand what occurred on January 29th, one must first understand the peculiar structure of the precious metals market, a structure that creates vulnerability. Unlike stocks, which represent actual ownership in companies, or real estate, which is inherently physical and location-specific, precious metals exist in two parallel universes, the paper market and the physical market. The paper market consists of futures contracts, options, certificates, and exchange-traded funds. These are financial instruments that represent claims on gold or silver, but are not themselves gold or silver. An investor can buy and sell these paper claims without ever touching actual metal. The physical market involves actual bars, coins, and allocated storage. When transactions occur here, metal changes hands or moves between vaults. Here is where the vulnerability emerges. The paper market is vastly larger than the physical market. Analysis of the COMEX data reveals that on any given day, the volume of gold traded in futures contracts exceeds the entire annual global gold mining output. The leverage is extraordinary. Estimates suggest that for every ounce of physical gold in allocated form, between 90 to 250 ounces of paper claims exist. This structure creates a unique opportunity for those with sufficient capital and market access. On the morning of January 29th, someone, or more likely a coordinated group of entities, executed what traders call a slam. Between 8:20 and 8:37 a.m. Eastern Time, massive sell orders flooded the COMEX futures market. The volume was extraordinary. In those 17 minutes, approximately 18,000 futures contracts were dumped onto the market. Each contract represents 100 ounces of gold. That's 1.8 million ounces, roughly 56 metric tons, sold in less than 20 minutes. To put this in perspective, the largest gold mining companies in the world produce approximately 100 to 150 tons per year. Someone sold more than one-third of a major mining company's annual production in 17 minutes. The pattern of selling was equally revealing. These were not small orders distributed throughout the session to minimize market impact, the strategy any rational seller would employ to get the best average price. Instead, large blocks hit the market simultaneously, overwhelming available buy orders and triggering cascading stop-loss orders from other traders. This is not how someone sells who wants the best price. This is how someone sells who wants to move the price itself. The timing was strategically chosen. The attack occurred during the overlap between the end of Asian trading hours and the beginning of the New York session, a period when liquidity is present but not at its daily peak. European traders were mid-session, but many American traders had not yet fully engaged. Furthermore, 8:30 a.m. Eastern Time is when major U.S. economic data is typically released. Trading algorithms are programmed to expect volatility at this moment. Unusual price movements at 8:30 don't trigger the same algorithmic warning flags they might at other times. The execution bore the hallmarks of sophisticated institutional operation, not panicked retail selling, or even typical hedge fund positioning. But the mechanism extends beyond simple selling pressure. Analysis of the commitment of traders reports, published weekly by the Commodity Futures Trading Commission, reveals that in the 3 weeks preceding January 29th, a specific category of traders had built up unusually large short positions. These traders are classified as swap dealers, typically large banks that facilitate trading for clients and manage their own proprietary positions. Their short position in gold futures had reached levels not seen since 2019, representing bets that gold prices would decline. When prices did crash on January 29th, these positions became highly profitable. The skeptical observer might argue this simply represents smart trading. These institutions correctly anticipated a price decline and positioned accordingly. But this interpretation ignores a crucial fact. These same institutions have the market power to create the very price decline they bet on. If an entity holds a massive short position and also has the capital to dump enough futures contracts to crash the price, they are not predicting the market. They are making the market. This is the mechanical essence of manipulation in the paper-dominated precious metals markets. Yet the mechanism still doesn't explain the geographic divergence. Why New York crashed while London, Mumbai, and Shanghai held steady? The answer lies in the technical architecture of international gold trading. COMEX trades gold futures, derivative contracts. London trades spot gold, immediate delivery transactions. While these markets typically track each other closely due to arbitrage, they operate on different technical infrastructure with different participants. The attack focused specifically on the COMEX futures market. The selling pressure was concentrated there. While this normally would drag down London prices through arbitrage, something else was simultaneously occurring. Physical gold buyers in Asia and the Middle East were actively purchasing during this exact window. Central banks, which typically operate with discretion and rarely rush transactions, appeared to accelerate their buying programs. Data from the Shanghai Gold Exchange showed unusually high withdrawal volumes in the days following January 29th, indicating that buyers were taking physical delivery, not merely trading paper positions. This created a countervailing force. While paper was being dumped in New York, physical metal was being absorbed in Eastern markets. The result? A temporary fracture in global price discovery. The fracture revealed something profound about the changing architecture of global commodity markets, something that would have far-reaching implications for anyone conducting international business. The question was no longer whether manipulation had occurred. The evidence was clear. The real question was why. Every significant market intervention carries a purpose. Nothing of this magnitude occurs without strategic intention. To understand why the precious metals market was attacked on January 29, 2025, one must look beyond the markets themselves. The answer lies in the intersection of monetary policy, geopolitical power structures, and an accelerating crisis in sovereign debt management. The story begins not in trading rooms, but in government bond markets. Throughout early 2025, the United States Treasury Department faced an increasingly uncomfortable reality. The national debt had exceeded $36 trillion. Annual interest payments on this debt had surpassed $1.2 trillion, more than the entire defense budget, more than Medicare spending. Every quarter-point increase in interest rates added approximately $90 billion to annual debt service costs. This created a mathematical trap. The government needed to keep borrowing to fund operations and refinance maturing debt. But the more it borrowed, the more interest it owed. And if bond investors began demanding higher yields to compensate for inflation risk or fiscal concerns, the debt spiral would accelerate beyond control. In this environment, one metric becomes critically important: inflation expectations. If the public believes inflation is rising, they demand higher interest rates on government bonds to compensate for the declining purchasing power of future repayments. Higher rates mean higher government borrowing costs. Higher borrowing costs mean larger deficits. Larger deficits mean more borrowing. The cycle feeds on itself. Controlling inflation expectations, not necessarily actual inflation, but what people believe about future inflation, becomes a matter of fiscal survival. This is where gold enters the equation. For thousands of years, gold has functioned as a monetary thermometer. When confidence in government-issued currency declines, gold prices rise. When inflation fears increase, gold prices rise. When geopolitical instability threatens the existing monetary order, gold prices rise. The gold price, therefore, broadcasts a message about monetary stability. In the weeks before January 29th, gold had been rising steadily. It had broken through $6,000 per ounce in several Asian markets. Financial commentators were beginning to ask uncomfortable questions. Was this signaling a loss of confidence in the dollar? Was inflation returning despite official assurances? Were central banks worldwide quietly abandoning dollar reserves in favor of hard assets? These questions, if allowed to gain mainstream traction, would undermine the narrative that inflation was under control and the fiscal situation was manageable. The Federal Reserve and the U.S. Treasury, while technically independent entities, share a common interest in maintaining confidence in dollar-denominated debt. When gold prices surge, that confidence erodes. A dramatic takedown of gold prices sends the opposite message. The situation is under control. There's no inflation threat. Gold is just a speculative asset prone to crashes. But suppressing the price in one market while the rest of the world continues buying creates its own risks. It reveals the intervention itself. Unless the intervention serves a dual purpose. Here is where geopolitical strategy intersects with market mechanics. In the background of the January 29th event, a broader pattern had been developing for months. Eastern nations, particularly China, India, Russia, and several Middle Eastern states, had been systematically accumulating physical gold. China's central bank had reported gold purchases for 17 consecutive months. India's import data showed record volumes of gold bullion entering the country. Russian financial statements revealed gold comprising an increasingly large portion of international reserves. These weren't investment decisions. This was strategic repositioning. The emerging economies were preparing for a potential restructuring of the international monetary system, one less dominated by the US dollar and Western financial institutions. The BRICS coalition had been discussing the creation of a commodity-backed trade settlement currency. While details remained vague, the concept was clear: create an alternative to dollar-based international trade that couldn't be weaponized through sanctions or devalued through monetary expansion. Such a system would require substantial commodity backing. Gold was the obvious anchor. For this strategy to succeed, these nations needed to accumulate gold at reasonable prices before any formal announcement. A steadily rising gold price, especially one approaching or exceeding $6,000, made accumulation increasingly expensive. Here is where the strategic calculus becomes complex. A violent takedown of paper gold prices in New York serves U.S. interests by suppressing the inflation signal and maintaining dollar confidence. but it simultaneously serves Eastern accumulation interests by creating a temporary discount on physical metal. The divergence between paper and physical prices, New York crashing, while Asian and Middle Eastern markets held steady, allowed both objectives to be achieved simultaneously. Western financial media could report gold crashes with dramatic headlines, reinforcing the narrative that precious metals are volatile and unreliable. Meanwhile, Eastern buyers could continue accumulating physical metal at globally recognized prices that didn't reflect the paper crash. Evidence suggests this wasn't accidental misalignment, it was coordinated accommodation. Examination of central bank gold purchase data in the weeks following January 29th reveals something remarkable. While commercial Western investors were selling gold ETFs and futures contracts in response to the price crash, official sector purchases accelerated. Central banks worldwide added approximately 95 tons of gold to reserves in February 2025, one of the largest monthly accumulations on record. They were buying the dip, but not the New York dip. They were buying physical metal at global prices while the paper market crashed. This creates a paradox that reveals the true nature of modern precious metals markets. The paper market, dominated by Western financial institutions and priced in dollars on exchanges like COMEX, increasingly functions as a perception management tool. Its purpose is not price discovery in the traditional sense, but rather narrative control. The physical market, dominated by Eastern central banks, Middle Eastern sovereign wealth funds, and Asian retail buyers, functions as the actual commodity market where real metal changes hands at prices reflecting genuine supply and demand. The two markets were decoupling not due to technical failure, but due to fundamental divergence in strategic objectives. For business leaders navigating international markets, this divergence creates unprecedented complexity. A corporate treasurer in Germany hedging manufacturing inputs sees one price. A jewelry manufacturer in India purchasing physical inventory sees another. A mining company in South Africa negotiating forward sales contracts faces the question, which price is real? The answer depends on whether one operates primarily in the paper financial system or the physical commodity system. This bifurcation, this splitting of a single global market into two parallel pricing mechanisms serving different strategic purposes, represents something far more significant than a single day as manipulation. It represents the early stage of monetary system fragmentation, and it raises an urgent question for anyone conducting business across borders. In a world where the same asset trades at different prices depending on geography and market type, how does one manage risk, negotiate contracts, or plan for the future? The implications extend far beyond precious metals. The events of January 29th, 2025 were not an isolated anomaly. They were a revelation, a glimpse behind the curtain of how global markets actually function when strategic interests override economic fundamentals. For business leaders, entrepreneurs, and corporate decision makers, the critical question is not whether manipulation occurred. The evidence settles that question definitively. The critical question is, what does one do with this knowledge? The traditional framework for international business operations assumes certain foundational principles. Markets are efficient. Prices reflect genuine supply and demand. Arbitrage ensures global price convergence. Hedging instruments provide reliable risk management. January 29th demonstrated that these assumptions no longer hold universally. When a single commodity can trade at substantially different prices across integrated global markets for extended periods, every aspect of international business operations must be reconsidered. The first strategic adjustment involves price discovery mechanisms. Companies engaged in international trade traditionally rely on benchmark prices from established exchanges. A manufacturer in Vietnam purchasing silver for electronics production might reference COMEX prices. A jewelry producer in Turkey might use London spot prices. But what happens when these benchmarks diverge significantly? Forward-thinking organizations are now implementing dual benchmark monitoring systems. Rather than relying on a single price feed, procurement teams track multiple geographic markets simultaneously. Contracts increasingly include clauses specifying which geographic market's pricing will govern transactions. A practical example, a solar panel manufacturer negotiating a 6-month silver purchase contract might specify a price to be determined by the average of London spot and Shanghai physical at time of delivery, rather than simply spot price at delivery. This contractual precision protects both parties when paper and physical markets diverge. The second adjustment involves treasury management and corporate reserves. Traditionally, corporate treasurers held reserves in cash, short-term government bonds, and perhaps some currency hedges. The assumption was that these instruments provided stability and liquidity. But in an environment where monetary authorities actively manipulate commodity prices to manage inflation expectations and geopolitical positioning, the definition of stable reserve asset requires reconsideration. Several multinational corporations have quietly begun diversifying reserves to include physical commodities stored in multiple jurisdictions. This is not speculation. It is recognition that geographic diversification of assets provides protection when markets fragment along geographic lines. A European manufacturing conglomerate, for instance, might maintain operating reserves partially in Swiss banks, partially in Singapore, and partially in physical form in secure storage facilities. When price discovery breaks down in one jurisdiction, operations continue smoothly using resources from another. The third strategic consideration involves hedging in manipulated markets. Traditional hedging assumes that derivative instruments correlate reliably with underlying physical assets. The airline hedges fuel costs by purchasing oil futures, confident that futures prices will track physical oil prices closely enough to provide effective protection. But when futures markets can be deliberately moved independent of physical market realities, hedging becomes complicated. Risk managers are responding by shifting toward physical-backed instruments rather than purely financial derivatives. Instead of paper gold ETFs, some are using allocated physical gold with redemption rights. Instead of futures contracts alone, some are negotiating direct supply agreements with producers. This approach sacrifices some liquidity and convenience, but provides protection against the kind of paper-physical divergence witnessed on January 29th. The fourth adjustment involves monitoring systems and early warning indicators. Business leaders cannot spend their days analyzing commodity markets. They need efficient systems that alert them to conditions requiring attention. Several specific indicators now warrant systematic monitoring: the spread between COMEX and Shanghai gold prices. When this exceeds $50 per ounce, it signals potential market stress or intervention. Monitoring this spread weekly provides early warning of intensifying manipulation or system fragmentation. Central bank gold purchase data, released monthly by the World Gold Council. When official sector buying accelerates while prices decline, it indicates that sophisticated actors are taking the opposite side of the trade from commercial investors, a strong signal that the price decline is artificial. The ratio between paper gold trading volume and physical delivery requests. When trading volume is extremely high but delivery requests remain low, it suggests the market is dominated by financial speculation rather than genuine commodity demand. This environment is more susceptible to manipulation. These indicators can be monitored by a junior analyst in less than an hour per week, yet they provide strategic intelligence that protects against being caught on the wrong side of market interventions. The fifth consideration is perhaps the most important: understanding manipulation as policy signal rather than market noise. When governments and central banks intervene dramatically in markets, they are revealing their priorities and concerns. The January 29th intervention signaled that monetary authorities view rising gold prices as a threat significant enough to warrant extraordinary action. This tells business leaders something crucial. The official narrative about economic stability and inflation control is not matched by official confidence. If authorities were truly confident, they wouldn't need to manipulate perception so aggressively. This gap between official narrative and revealed priority creates strategic opportunity for those who recognize it. Companies planning long-term commodity procurement might accelerate purchases when they observe intervention creating artificial price suppression. Real estate developers in emerging markets might adjust project timelines based on signals that currency stability is more fragile than officially acknowledged. The intervention itself becomes valuable intelligence. The sixth strategic framework involves network development and information sources. Mainstream financial media largely failed to recognize or report the significance of the January 29th divergence. Most coverage simply repeated the profit-taking narrative without examining the underlying mechanics. Business leaders who rely exclusively on mainstream sources for market intelligence operate with incomplete information. Building relationships with participants in physical commodity markets, refiners, wholesalers, vault operators, freight companies, provides ground-level intelligence that financial media misses. These participants see the actual flows of physical goods, which often tell a different story than paper market prices suggest. Industry conferences, trade associations, and direct supplier relationships become intelligence networks, not just commercial relationships. The final consideration is scenario planning for system fragmentation. The January 29th event demonstrated that global market integration cannot be assumed as permanent. Political decisions can override economic integration rapidly. Forward-thinking organizations are now developing operational plans for scenarios where the global economy fragments into regional trading blocks with different pricing mechanisms, different reserve currencies, and different regulatory frameworks. This doesn't mean abandoning global operations. It means structuring those operations with sufficient regional autonomy that they can function if global price discovery mechanisms break down or if currency controls separate markets. A manufacturing company might establish separate subsidiaries in different regions, each capable of independent operation with local suppliers and local currency reserves. An investment firm might segregate client assets by jurisdiction to protect against capital controls. These preparations seem excessive in stable times, but January 29th, 2025 revealed that these are not stable times. The manipulation of precious metals markets is not a peripheral issue affecting only gold dealers and commodity traders. It is a symptom of a monetary system under stress, revealing that the authorities managing that system are willing to override market mechanisms when those mechanisms produce inconvenient signals. For business leaders, this knowledge changes everything. The markets are not neutral playing fields governed by supply and demand. They are battlegrounds where monetary policy, geopolitical strategy, and economic reality collide. Success in this environment requires seeing beyond the surface prices to the strategic forces moving beneath. Those who understand what happened on January 29th possess a crucial advantage. They know that the game has changed, and they can adjust their strategy accordingly. Those who dismiss it as a mere technical anomaly will continue operating under assumptions that no longer reflect reality. And in a fragmenting global system, outdated assumptions are the most expensive mistakes of all. The evidence is clear, the mechanisms are documented, the strategic implications are profound. The only question that remains is, what will you do with this knowledge? If this analysis provided value, ensure you're subscribed to Global Finance Revealed. Share this with colleagues who need to understand what's really happening in global markets. And tell us in the comments, has your organization adjusted its strategy in response to increasing market interventions? How are you protecting your business in this new environment? The conversation continues below.